All right, everybody. I am thrilled to get started with this amazing panel of CEOs we have for you. Now, these are DealMaker's fab and favorite CEOs. They're disrupting a bunch of different industries I'm going to ask them to tell you about. And they're also disrupting the way they raise capital by bringing in retail. So we've got Teague, Egan, Ben Sexton, Rich Hull, and myself, Rebecca Casaba. Let's get started over at the end with Ben. Can you tell us a little bit about how you're disrupting the world and how much retail capital you've raised, Ben?
Sure. Thank you, Rebecca. So we are disrupting the world with surgical robotics. We are commercializing an orthopedic robot, but we have plans for other clinical applications. We've raised in excess of $70 million, in large part, or almost entirely due to your support. So thank you very much for that. And I think some of the other panelists have raised potentially more than us, but I think we have the best investors in this group.
Love it.
Yes.
Already starting controversy. I love it, Ben. I'm Rich Hull. I'm the CEO of Miso Robotics. Miso launched 7 years ago with a burger flipping robot named Flippy. And then very quickly, Flippy migrated over to the fry station where he cooks French fries and chicken nuggets and pretty much everything you can cook on a fry station. And we tried to change the name to something fry related. Nobody can come up with anything better than Flippy. And so it stuck. Plus, probably thanks to the efforts of Rebecca, Flippy at the time and still has a bunch of Instagram fan clubs, and he's become kind of a cultural phenomenon. So we kept it. And I'm relatively new to Miso. I've been here about a year. We've raised north of $100 million of retail capital.
Amazing.
I think I've eaten some fries from Flippy before. But, I'm Teague Egan, the CEO of EnergyX. And EnergyX is an energy technology company that focuses on the battery material supply chain. So we're specifically focused on lithium extraction and production, which is the critical limiting factor and bottleneck essentially to the whole electric vehicle revolution. We invented disruptive technology that produces lithium far more efficiently, about 300% more efficiently than existing methods. And now we're building 2 big lithium projects to produce enough lithium for approximately 1 million electric vehicles a year. So those 2 projects are under development. Retail capital has been a huge part of our funding mix. However, we have supplemented that with institutional capital from great strategic partners. But in total, the amount of retail capital that we've raised to date is approximately 90 million, I think. And we just completed, I believe, the first ever full $75 million Reg A, which is the max that you're allowed to raise in a year. And that's with great thanks to Rebecca and the whole DealMaker team.
Amazing. Thank you, guys. So this is so great to hear about these disruptive businesses that are changing the world and are powered by you guys, the retail investor. So let's dive into how you guys think retail capital has helped to fuel your business's growth. Ben, let's start down there with you.
Sure. So our average investor is around 65 years old, and we're starting with total knee replacements. So our surgical robot, which is named Emboss, which pretty competitive with Flippy in terms of good naming. So we're starting with that application, and it really resonated with our audience. So we kind of have, I'll say, kind of future patients that I think had some passion with what we're doing. What it enabled Monogram to do was really innovate in the space. So beyond just investing in a company with the expectation of a return, they were supporting a new technology that was going to be very disruptive. And so it really enabled the company to develop technology where capital wasn't available initially for what we were doing. I think Richard kind of talked about, or not Richard, sorry, Teague talked about institutional capital. Sometimes retail capital could be the stepping stone for institutional capital. I expect that's going to be the case with Monogram. So it really allowed us to hit critical milestones that we needed to hit in order to access deeper pools of capital. So it's been a tremendous, tremendous opportunity for Monogram and hopefully for our investors.
I think
amazing. Rich, let's hear from you how the retail investor has powered Miso's growth.
It surely has, but I think Ben hit upon something really interesting, which is the idea that he's doing surgeries probably for older clients, patients, and those are the people that are also investing in you. So there's a certain market efficiency there where the market may not necessarily know that there's a great company, but the customers know that there's a great company. And so when they can then come in and support that, I think that's kind of part of where the magic happens here. I think for us, we, unlike you guys that have a very specific demo of investor, we have 40,000 investors. It's about an average ticket size of about $3,500. And they range in age from young, medium, and old. And I think that's interesting. And to me, the reason is everybody understands restaurants. We've all eaten at restaurants. And Flippy is just such an intuitive product. Restaurants are having a really hard time hiring people to work in the kitchen today. During the pandemic, we thought that there was a lot of publicity about it, and we thought that was kind of a temporary phenomenon. But in reality, it was just accelerating something that was already happening, and it's a permanent issue. And then our friends at the state of California recently did us an extra solid by increasing the minimum wage to $20 an hour in restaurants. And so now it's really hard to hire people. You can't. And the people that you can hire, you got to pay a lot. And so you want those people to work in a high-value position. That could be washing dishes. It could be front of the house, doing upsells. But the fry station is not one of them. Nobody wakes up and says, gee, I'm going to burn my arms all day and smell like grease. And so by taking that off the table and just automating that, we make restaurants far more efficient. We're kind of saving the restaurant business because if you can't hire people, you can't open. And so for us, those are the people, those restaurant customers are the people that come in and they support us. And in a weird way, that's kind of our secret weapon. That's like my word of mouth marketing army that other companies don't have. So they go out and they tell their friends that they're an owner of Flippy and they go visit Flippy. And there's sort of a flywheel there that kind of keeps it going, which I think is super interesting.
And that actually ended up with you guys getting featured on Saturday Night Live, right?
We did. I mean, Saturday Night Live, we've gotten a lot of publicity. Flippy's kind of got his own little personality, and it's pretty interesting. That's
the power of organic social. I love it. And I love that you guys have such different retail communities that your story appeals to. Teague, what about you?
Real quick, how can I watch that? What, like Saturday Night Live Flippy or Miso Robotics or which episode?
Probably all the above. It was on, we've actually been featured on a bunch of shows, including Saturday Night Live. The last one I saw was on Weekend Update on SNL. So I'm sure a Google search will produce that for you.
Okay, cool. You know, I think for me, I just want to talk a little bit about retail investing in general and what it meant for our business. But doing Reg A and retail investing, I think is a huge breakthrough for the whole financial market. It really is it's a disruptor to the status quo of how companies like us are able to raise capital. Traditionally, we've been limited to very few avenues of raising capital, mainly venture capitalists. And while all money is green, venture capitalist money is a lot more difficult to obtain. It's red in a sense. And not only is retail investing disruptive, but it's disruptive because it decentralizes the ability to raise money, and C, democratizes it. And if you are beholden to a very small or few amount of venture capitalists that hold all the power, that gives you very little leverage in either the terms that you're trying to raise capital on or the valuation. And for EnergyX, when we started out, I put in the first $1 million of capital to start the business, but then I went and had to go raise outside capital, and I felt like my valuation was somewhere in the $50 to $60 million range because of some of the milestones that we had hit. However, when I approached the venture capital market, they were trying to offer me, they're trying to beat you down and take huge percentages, get seats on your board and control the company. All these things that they're able to do because they have the money and hold the power. And it was around that time that I learned about crowdfunding. I said, I'm gonna go test this in the market and see, not what 5 people are telling me, but what the general population is telling me. And today, this conference as proof just shows the power of the retail investor, somebody that is looking to either A, trade stocks and make money on their own accord, or B, be able to invest in private companies that have that exponential growth capability. That's the other aspect that has been kind of limited to the good old boys club, the venture capitalists or the private equity guys that have been able to make huge returns on explosive growth companies like Uber or like Facebook that the regular person is only able to invest in once they go public. And that is not the case anymore with Regulation A. And I think that is such a powerful tool, not only for our companies, but for retail investors as well.
Teague, I think you're right, because I think that means equity crowdfunding is fulfilling the promise that it set out to do, which is, the premise originally was the rich get richer because they get access to the Facebooks and the Googles before they're public, and they don't get the benefit of that explosive growth. The explosive growth, I think, is a great phrase, right? Because that's what drives this. But also, on the flip side, and you mentioned this earlier, when you've got retail investors meeting institutional and strategic investors on the same cap table, that's kind of a validation of the company, right? And so like for us, for instance, we took a investment from Ecolab recently. Ecolab is a $70 billion public company. They sell cleaning solutions to every restaurant you've ever been in. And they're a great strategic partner, but now putting them on the cap table with a bunch of retail investors, super interesting, but it also validates everything that the retail investors have come in and invested in, right? And so I think that collision of those two worlds is sort of what we're seeing now. Now that you've got companies that have raised a significant amount of equity crowdfunding, like all of us, you are seeing the institutional and the strategic investor community coming in, paying attention and saying, oh, we like that, let's jump on board.
I love that. I totally agree. That's the way I funded DealMaker as well, right? And I had a mix of benefits coming from the retail. They're sending deals, they're putting deals on the system, and then the institutions are giving me a different value. And I think that's the model that we all see and feel the benefits of, and we want to share with the market. And I love that you took it so broad, Teague. That's why you've become such a great friend to me with your great vision. And the Wall Street Journal said it last week, and I agree with them. So let's jump to, are there any perhaps unexpected ways the retail investor audience added value to your business? And Ben, specifically for you on your NASDAQ IPO, maybe you can focus on that. Was there anything about the retail audience that surprised you?
Sure. So for those of you that don't know, we just closed oversubscribed. Can you hear me? We just closed an oversubscribed round that we did with DealMaker. We're a publicly listed company on NASDAQ. Our ticker is MGRM. And it was a very interesting deal that we put together and very innovative, Rebecca, with the help of your team. We offered preferred shares. Our common shares are listed with a dividend and with a warrant. So it was structured very similar to what an institutional investor would get, but our retail community had access to the deal. At one point, the common shares were trading at a significant premium and still are to the common shares. So it ended up being a deal that had liquidity for investors coming in. It was very attractive terms just with respect to where the common was trading. And I think this is going to open up a whole new funnel of opportunities for the retail investor where they're underserved. So today, the average retail investor isn't getting access to, let's say, a PIPE deal, a publicly traded company private deal. With crowdfunding, that's going to become possible. And just like you were talking about getting access to pre-IPO companies, I think the retail investor is going to start getting access to equity that's being offered by publicly traded companies with favorable terms. So this is something that's really transformative for the industry. What's really exciting to me is I want to see our investors, it was more important for me that our retail community that had been supporting us for 6+ years had access to the opportunity versus a VC that we met yesterday and that doesn't really have the same kind of skin in the game in terms of caring about our product. So it's also a way for companies to give back to their loyal audiences over time, to give them access to deals that maybe would only have been available for institutional investors. So that's one of the things that's very, very exciting. I think it's going to be transformative for the capital markets over the next 5 to 10 years. I think middle market investment banking is going to be completely disrupted by this business model. That's my thesis, and we're excited to be a part of it.
I know a lot of people are echoing that thesis as well. I love that.
Yeah.
I think what Ben is doing, and you guys are doing with Ben, Rebecca, is really kind of the next evolution of equity crowdfunding, right? It's the bridge to one step further into the public markets. Like, we think about that a lot. You just finished a round. We are finishing a round tomorrow, right? So tomorrow at midnight Pacific time is the absolute last chance to invest in our equity crowdfunding round that we're doing right now. But we think about, well, what is the next step after that, right? And we think about, do you go and you sell to a financial investor, a strategic investor? Do you go public? And if you do go public, and now we're starting to see green shoots in the public markets. There weren't a lot of IPOs over the last couple of years, but now it's starting to come back. In our space, one of the most successful IPOs in the last year is Cava, which is a restaurant business. So that's actually really interesting for us, given that we're kind of in restaurant-adjacent businesses. And we think, like, okay, well, what do our 40,000 retail investors mean if we decide that we want to go public as a next step? That's a really interesting roadshow, to walk around and say to the institutional community, well, I've got 40,000 people that have already raised their hand and sent a signal saying that they want to support this company. They already have as a private company. They surely will as a public company. I don't think we've seen that before. I think what Ben is doing is kind of the closest thing to that, right? And so, well, I guess we did see it with you guys when you went public. But today, now you're leveraging your prior equity crowdfunding investors who want to double down and continue to support you as a public company. That's super interesting.
Yeah, and they are doubling down a lot, right, Ben?
Exactly. So we had a lot of, investors who have been with us for a long time, and I think companies like on this panel that actually care about their investors, it's possible for companies to structure deals that they hope will be accretive. Obviously, there's no guarantee of any returns from anybody here, but it's what's fun about the capital markets is you have the liquidity. So the hard thing for companies that aren't public is an investor can maybe realize a return. You can hit my critical milestones that increase the value of the company, but if an investor wants to tap out and buy something with that hard-earned capital, they can't. They don't have access to liquidity. What's exciting about the public markets is our deal was instantly accretive at some point. So we were offering preferred shares at $2.25, and it was trading at a 75% premium at some points during the raise. So somebody could have literally converted their shares, made a profit, and sat on a warrant. So this is really a very interesting model, and I think if companies are smart about how they structure deals, they can be very accretive potentially to their investor community and with instant liquidity. So I'm tremendously excited about what this means. And frankly, we've been talking to a lot of investment banks. We have securities attorneys that we talk to that were somewhat skeptical of this business model. It's new. And when they saw the success of this model, they're don't talk to anybody ever again. This is what you should do for the rest of the life of the company. Okay, well, obviously strategic capital has its own benefits, but it's very attractive for everybody. The best situation is when you have a win-win, a win for your investors, a win for the company, and I think that's what DealMaker helps companies achieve. So.
Amazing.
Yeah.
Teague, let's bring it back to you. Any unexpected ways retail capital has helped the business?
Yeah. Like I said, all money is green, right? And that money has been more than 50% of our capital raise mix, which has allowed us to execute on our operational milestones that have pushed the company forward. Now, having an investor base of 40,000, which is where we're comparable to that, is a pretty cool marketing tactic. We just had an incredible Wall Street Journal front page profile last week, and now we have 40,000 people sharing that because they're excited that they're an angel investor in this company that has succeeded thus far. So I think that having that loyal fan base. Now, EnergyX isn't a consumer-facing product, so there's that, right? But it's still exciting, I think. And I don't even think that we have fully unlocked the power of what it could mean on the public markets. Now you have, which is cool, and you've actually seen the benefits of that. We're still private, and I think that I'll always shoot it straight. There's pros and there's cons to that. Like, they have access to these highly explosive growth companies, but for us, there's still no liquidity, right? And that's the risk that the institutional investor maybe can bear, and that's why they're rewarded. Now that's the option of the retail investor. Okay, so it's been a few years, not that many, 3 years since we did our first crowdfunding offering, but those investors have seen a 10x return, but we're yet to have a liquidation event, either an acquisition or a go public offering. At some point, a secondaries market might evolve, which would be great. But we've seen a lot of benefit from the retail investor, and I think that there's still more to be uncovered.
I think it's so interesting how you guys have leveraged the organic social component. Whenever I talk about what DealMaker does, people automatically assume that it's going to work best with a consumer-facing brand. And you three sitting here are proof that it actually doesn't necessarily need to be. And you can leverage the power of the retail investor and the power of that crowd you've built to help propel the business forward, regardless of what it is to do, which is really exciting. I spend a lot of time in Washington talking to the legislators about crowdfunding and how to change the legislation. And this is exactly what they intended, right? They wanted to give retail investors like you guys access to alts and access to things that only institutions were getting access to previously. And you guys are here proving out the model. So it's amazing to see.
But I think everything you said is so true, right? But everything Teague said is so true as well. And we just saw something very similar, like a perfect example of what you're talking about. And, we too were talked about in the Wall Street Journal. We saw tons of pickup of that from our investors who passed it around and really enjoyed that. But over the summer, we have the Miso Innovation Lab, which is where we kind of experiment and we think about future products and think about future growth. And the guy across the street from us at our office in Los Angeles said, "Hey, I'll give you free rent in this restaurant space I've got for the summer, and it's fully equipped with a whole bunch of equipment. You guys want it?" And we thought, yeah, we do. We don't necessarily want to be in the restaurant business, but our industry has been talking about the semi-autonomous kitchen of the future where humans and robots work together, and nobody's ever proven that out, though. And we're like, screw it, let's just do it. And we did it. Well, what happened is that got amplified because all of our investors wanted to come and check it out. And a lot of those investors have big social media followings, and then they shot videos and they posted it, and it kind of became this self-fulfilling thing where it drove a lot of success. So that's a consumer-facing application, but I think what you're talking about with non-consumer-facing applications is also interesting because it's all about emerging growth. Most retail investors don't get the opportunity to invest in private emerging growth companies. And in our space, which is, we make AI-powered robots, there's not that many places in the public market to get exposure to AI investing. You can invest in NVIDIA, and that's it, right?
That was a pretty good investment.
That was probably a pretty good investment. But if you miss that one, where else are you going to deploy capital to basically get the upside of AI? We know AI is going to change that. So we provide, as an AI-driven company, we provide that, even though we're not consumer-facing, we provide the opportunity to give retail investors that exposure to those emerging growth deals, just like both of these guys have, right? We're all doing super innovative stuff.
Yeah, I love that. That's so true. That's exactly the power of the community. So let's dial in on that point. Do you see it as a strategic advantage to you, like in the industry that you're in, vis-a-vis your competitors, for example, or maybe on an exit? Ben, do you want to start?
Sure. So we're playing in the orthopedic market. And for those of you who don't know anything about the orthopedic market, our average competitor is over 100 years old, right? And this business has been around a long time. There's 4 companies that account for more than 75% of the market. It's an oligopoly. it's not really what you would call an opportunity-rich environment for a small startup with not a lot of capital, right? So, how does how do you take advantage of the arbitrage that's obviously there, though? Because these companies are not innovating in a way that we think they can. What crowdfunding allows companies to do is maybe where the story is challenging or difficult, or where there's sort of a barrier to the first critical milestone. It's that, for us, that's what it was. It's the opportunity to actually prove that, yes, tech bros can come into the orthopedic market, which is what our customers have called, our competitors have called us. You know, there was I would say a healthy skepticism of what we were trying to do, and VCs that we talked to shared that skepticism, right? Their skepticism in our case, and maybe everybody has unique challenges when you're a startup founder. In our case, it was, yes, there's an obvious problem, there's an obvious opportunity, but you don't have a team and you don't have a product. So you just have an idea. Well, what do you do? You can't offer people options in a company that has no liquidity to pay the bills, right? There's only so many people who can't get paid as founders for 3 years. So crowdfunding was the seed capital that Monogram needed to actually do something disruptive in a market that hasn't seen innovation in 50 years. And so that's what's tremendously exciting for us. And I think it's, you know, the mission of our company is to advance the standard of care in orthopedic medicine and medicine generally. And we have I'm really proud to say the turnover rate at our company is almost zero. The employees who have been with us from the start are still with us. And I think there's also an element with crowdfunding where you can make decisions. Teague kind of touched on this with VCs. You can make decisions that are best long-term because you don't have a VC breathing down your neck that doesn't really understand the market, doesn't really understand the technology. And that's what's made our business so sticky. And I think that's why we are going to be commercializing the most innovative product the orthopedic market has seen pretty much ever. So I am tremendously excited. It's all thanks to, you know, Rebecca, your team, our investors who have stuck with us and believe in the story and believe in the opportunity. So for us, we had a community that's not really, we're kind of weird because our customer is not directly our customer. Our customer is actually a hospital and a surgeon, but the ultimate patient is advocating to their customer on our behalf. So it's really a really nice synergy that's happening as a result of the crowdfunding. We are very annoying to surgeons, but now when they come in and see our product, we're not really annoying anymore. They can't wait for it to get to market. So it's really exciting. So yeah, thank you for that.
Well, I think Ben, you know, really hit on an interesting word, which is disruption, right? Because I think that's kind of a consistent theme with all of us. We're kind of coming into an old, tired market and disrupting it. And we're very similar, right? So for us, restaurant kitchens have not innovated in 50 years. They've been operating the same way. The front of the house innovated probably 15 or 20 years ago. There was online reservations, Open Table. The former president of Open Table sits on our board, so he talks about this a lot. And he talks about the disruption that was happening 15 or 20 years ago in the front of the house. Point of sale systems, something that really disrupted the front of the house. But the back of the house has been operating literally the same way for decades. So our mission is to come in and disrupt that. Just like your mission and your mission is to come in and disrupt old, tired businesses. And I think about the public companies in our space that have been selling products to restaurant kitchens. They too haven't innovated. I mean, they're like the Blockbuster Videos of our space, right? We know which direction they're going. They're kind of old, tired dinosaurs. They're either going to buy us or we're going to buy them, but something's going to get disrupted. And I think that's really where equity crowdfunding comes in and gives you that extra push, right? So it's a win-win for the investors. It's a win-win for the company, right? Because everybody benefits in the end. It really does align everybody's strategic agendas, right? And so, like for me, you know, I too was an early investor in this business before I came to run it. So my outcome is tied to my investors' outcome, right? My whole job is to drive shareholder value, which benefits the investors, but it also benefits me personally because I was one of the first guys on the cap table. So I think that's part of the brilliance here, right? Is you get to come in and you get to power that disruption, and you just don't see that in the public markets.
That's an amazing point on the alignment between you and the community, because you're aligned with the retail's interests, so you're building the same thing. And Ben, I think it was a really interesting point you crystallized for me, that sometimes when you're taking a product to market, right, like surgeons aren't necessarily going to be super adoptive of a new technology. But then if you've got the community pulling it and asking for them, that's helping you bring it to market and helping you cause that disruption to happen. And that's where the retail knows something that the big institutions don't, because they're just locked into the way they do things, even though the way they do things might have more risk. But the retail is saying, hey, look, guys, we want this. We want things to be done in a new and exciting way. Yeah. They know someone who had a bad surgery, and so they want a different solution to the problem, even though the medicine might be sitting there and saying, no, it's fine. Like the way we do it's no problem.
Yeah, I mean, for us, there's not a strategic advantage in the sense the way that some of our other investors provide strategic help. Like General Motors is one of our biggest investors. Like obviously they're going to buy hundreds of thousands of tons of lithium from us. We have some other major strategic investors like POSCO, that's a big lithium producer themselves, and a cathode producer, so they will utilize our technology in some of their mines as well as purchase lithium from us. But I think that the examples that you guys gave, every company is different, right? For us, the strategic advantage is to get the word out about EnergyX more, build our profile within the battery industry, within the lithium industry, that then attracts additional capital and increases our leverage position for further institutional raises. We have kind of flip-flopped back and forth on raises. So like, after I put in the first a little bit of capital, like $1 million, then we went and did a crowdfunding round at 60 million valuation, and then that led to our first institutional financing, which was like 10 or 15 million bucks. And then we went back and did more crowdfunding and raised another 10 million. And then that valuation that we commanded there led to our major institutional round with General Motors, POSCO, and Eni, which is the big Italian oil and gas conglomerate. And now we've just completed our last crowdfunding round, which will probably set the valuation for a forthcoming institutional round. So I guess you could view that as a strategic advantage. It really helps justify to our institutional investors the valuation that the market believes the company is worth.
Yeah, absolutely. And I don't think you can put a price on just the general awareness you brought to the category, so that when someone's talking to someone and they know your new technology is out there, like, why aren't we using this? We should be using this. I know we have a mic. We had a mic set up for questions. If anyone has questions, feel free to come forward and I will give you the mic. In absence of that, I think I would be remiss to have such an amazing panel of CEOs up here if I didn't ask you to give a little bit of advice to the listeners on how you're building your company, what you think the key strategic things are for people to be focused on when they're building a company in this new digital age. Ben, you want to start?
Nice. That's a heavy question. So I think when I think about, we've been talking a lot about the advantages of the retail investor. I think it really boils down to time preference. With our investor community, there's not a lot of pressure for us to do things because we're on a certain clock that's established by this cohort of people. We can do what we think is right for the company. And for institutional capital, that's just not always the case. They have their own sort of strategic objectives at times. I guess my advice would be a couple things. One is find at least one other person that you can suffer with. So for me, that was two people. One was my wife, who suffered just as much as I did. Our business was actually funded because of her for like 3 years. And then our surgeon co-founder, Dr. Yunus, who's still a practicing orthopedic surgeon, he just the number of things that we had to go through and the number of times that we would have given up if we didn't have each other, you couldn't even count them. So sometimes founders are really sensitive about, this is my idea, I don't want to share it with anybody. I would invite you and encourage you to have a bigger mindset where 50% of something very big is a lot better than 100% of something very small. And so find a couple key people that you can really do this with and that have skills that you don't have, and be okay with people being better than you. Know what you're good at and be comfortable having other people that are better at certain things than you, and be comfortable handing the microphone to them if that's a better audience for them to address than you, and be really humble about it. So those would be my 3 things. Make sure you have somebody who's helping you kind of push this behind the scenes. And for me, that was my spouse. So my wife was really the reason we exist. And then obviously DealMaker when this landed. That's my advice.
I feel like we could have a very long conversation about long-suffering spouses for private company operators and founders. That can be our next panel, I guess. I think everything Ben says is absolutely correct. This is a team sport. You can't do it alone. And if you don't have that, it's almost not worth doing. I'd say for my part, I wasn't the founder of Miso, even though I was an early investor. And I was the founder of another company, though, which is called VIX. VIX is the largest Spanish language streaming service in the world, and I founded that with some other people, right? And we added some founders along the way because we had an exit. We sold to Univision, and then we rolled up some other streaming services into that. The team at Univision became a founder as well, right? And so success has got a lot of fathers, I'm sure if VIX was a failure, everybody would be pointing at me. But but now that it's a success, everybody's part of the founding crew, and that's awesome. For me, I think when I came into Miso, though, it was about focus. Product focus. And so Miso had announced some other products along the way before I got there. They had a beverage robot called Sippy, and a tortilla chip making robot called Chippy, and a coffee robot called Drippy. Like you get the gist of how we name these things here. But I kind of took a page from the Steve Jobs playbook when I came in. Steve Jobs had been gone from Apple for a dozen years. He came back, they had 40 products, and he very famously cut them down to 2. And I kind of did the same thing. I said, look, let's stop trying to do 5 or 6 products. Let's come in, let's pick one. We chose Flippy. He's our signature product. He's far and away the largest revenue opportunity for us, which is a $4 billion revenue opportunity for us. While we want to go and disrupt and automate the entire kitchen, which is more of a $15 to $20 billion revenue opportunity, we wanted to start first with Flippy. Nail that, and then earn the right to expand into other products. So I think it's focused, and we're doing that right now. We actually when I came in, we took the current generation of Flippy and decided that we would go back and improve it and create a next generation Flippy. So the one that we have today that just started rolling off the assembly line last month, the first one was installed at a White Castle location last weekend. The second one gets installed at a White Castle location next weekend. That's half the size, twice as fast, half as much to manufacture. It's far more reliable. It's 70% less time to install, which means a lot less lost revenue for restaurant customers. So we really doubled down and created focus that I'm not sure existed before. And I think that, to me, is sort of like if you take the team sport aspect, the focus aspect, and probably whatever Teague is going to say, right? That's a nice 3s. That's a nice round number. Those are kind of like the 3 successes to being a startup founder, if you think about it.
Yeah, I have a little bit different of an approach. I'm a sole founder, and I am not married, so I don't have a suffering spouse there with me. But I take pride in the fact that I'm the only one to really, really suffer. I mean, my job is to make it so that others don't have to suffer. I'm more than willing to take all the suffering so that those around me don't have to feel that. I think that my one piece of advice for other founders that I think EnergyX and I have done pretty well is that I've surrounded myself with an incredible team. And maybe that's the team aspect that was being referred to earlier. For instance, at this conference, we have our marketing team, Kelly and Courtney, and they are some of the best marketers and a huge reason that we were able to execute on one of the first ever, maybe the first ever $75 million Reg A. I think that from a technology standpoint, I went out and found some of the absolute smartest PhD scientists and engineers that helped us build world-class technology. From an operations standpoint, we're now building lithium production plants that are close to $1 billion in CapEx. And I've went and found some of the absolute best people that have done that before and built some of the other big lithium companies out there. So I will gladly take all the suffering so that they can go do their jobs adequately. And I've tried to go find the absolute best people in every position so that EnergyX can execute on our milestones.
Amazing. I think those three sum it up. So have an amazing team, be super focused, and hire the best of the best so that you can execute to perfection. I agree with all of those. That's what we do at DealMaker as well. So thank you guys so, so much. I really appreciate this. I know the audience really appreciates having all of your insights. You're breaking ground and disrupting in your respective industries, but you're also disrupting the way capital is raised. And we have so much respect for that. As if being a CEO and founder wasn't a hard enough job, you're doing the double disruption. So thanks, everyone. Really appreciate you listening. Have a great day.